Because what's happened so far is the market at the beginning of the year were pricing in 7 cuts or so. The Fed had communicated 3. What's happened now is that it's for the first time the market is pricing less cuts that the Fed has projected. So that's been one part of volatility. And the other part of volatility has been the Fed essentially, the Fed's speak has been one of more, inflation perhaps is not where we want it to be. And as a result, them sort of dialing back a bit of their narrative. I think that's probably been the biggest adjustment. The next wave of adjustment could be the market prices 0 cuts and the Fed also changes its narrative to also point towards 0 cuts. That could potentially be the second part of volatility. But as that happens, growth is resilient. We would be buyers. We would be looking sort of to redeploy some of the, because we've taken a bit of profits from the risk rally. Still constructive, broadly constructive on risk, just a bit more cautious given this Goldilocks reversal. But as and when we see more of that sort of volatility come through, we would be buyers of that because, again, global growth is very resilient.
On that front, what's your, I suppose, thoughts when it comes to what we're seeing? You had the FTSE 100 seeing record highs. We're seeing Europe continuing to catch a bid, even though some people are fearful that we are going to see significant, perhaps less significant than what they thought a couple of months ago, but recession in Europe, for example, or Germany specifically. So are you deployed in Europe right now? Are there ways in which that you can still invest even though we are seeing record highs?
Yeah. First of all, UK record highs. I guess very sort of weak sterling, so that's been quite helpful. Plus the composition of the sectors, commodities, banks, etc. So that I guess that's kind of it's special case. But when it comes to Europe, Europe is coming slowly. Europe kind of had its recession, and it's coming out of that recession. Perhaps kind of Germany and sort of the northern part essentially, perhaps not as strongly as other parts of Europe. But one of the markets that sort of quite like is Greek equities. And if you look at Greece, at a time when the rest of Europe has been experiencing kind of that mini recession, Greece has been printing sort of pretty strong GDP numbers. Its manufacturing PMIs have been quite strong. Unemployment still high versus the rest of the world, the rest of Europe, but dropping faster. And as a result, consumer sentiment has been strong. Retail sales have been strong. And Greece is, while it's had fantastic, phenomenal 2 years of performance, so one would argue, is this really the time to be buying? Is it expensive? Well, it's been earnings. We've got sort of, ROE has been improving, earnings have been improving. If anything, Greece still trades at a discount to the rest of Europe. And it's all about reforms and it's all about fiscal discipline. And you'd be surprised because 6-7 years ago, no one would associate those words with Greece.